First, let me perhaps summarize the latest quarter and actually fiscal year for Infineon, because if you look at the numbers, both for the fourth quarter and the fiscal year, we saw revenues coming in line with expectations and very much what the company had already guided to the markets in the past. However, I would highlight their outlook for 2025 as perhaps coming a little bit on the downbeat side. So investors could perhaps have a little bit of an issue with in terms of what they're guiding for next year when we see markets starting to open for trade in a couple of hours' time. But indeed, it is interesting to see that on a quarterly basis, we saw revenues increasing for Infineon. They very much said that every single part of the business contributed to that, including automotive. And that is an important development because we know there have been pressures here coming from the fact that car makers themselves had struggled with the transition for EVs, and that had put consequential, I should say, pressure on Infineon as well. Now, another interesting part of the conversation that I had with the CFO was around the sales in China and how important the Chinese market is for the company. And I also had the chance to ask him, really, why are they more downbeat when it comes to the performance next year?
Now looking into our fiscal 25, it's fair to say that the situation has changed quite a bit since we last communicated. Why is that the case? There is this very positive momentum still in China. I just saw the recent numbers for the last month. More than 50% of the new cars are now electric cars, so full BEVs or plug-in hybrids. So that's a very, very strong development. If you think about Europe, and that was your question, or also the US, the acceleration of the penetration to the electric cars has slowed down. That's clearly visible. And that, of course, leads to a certain, I would say, lower growth in these markets. On top of that, and that's also, I think, a perfect segue into our guidance for this fiscal year, we see a very pronounced, much more than seasonal, very pronounced inventory management on behalf of our customers, not only automotive, but also automotive customers towards their calendar and fiscal year end. And that, of course, slows down the demand for this and maybe the next fiscal quarter.
So is that the only reason why you lowered your revenue guidance for 2025, or are there more troubles on the horizon?
I mean, I think we have to differentiate here, Sylvia, into the cyclical picture and the structural picture. If we think structural, there are always these 5 mega trends. It's electrification, it's software-defined vehicle, it's IoT, it's renewables, and even more and more, it's data center / AI. So these structural trends are unbroken. They are very strong. Cyclically, indeed, there are 2 things which are coming together, not talking about geopolitical or macro uncertainties. There is this very pronounced inventory management. And on top of that, the customers are moving back to a very short-term order behavior. And if you take these things together, and if you look at the inventory also in the supply chain, for example, renewables, photovoltaic, there's a very healthy, strong demand. But before the demand can be translated into new and higher revenues, the inventories need to be first digested. So these are the main factors which are impacting the next quarters. Therefore, we are, I think, starting relatively slowly in terms of revenue, and that's why we have taken down the guidance for the fiscal year slightly, but fully in line with peers.